Can you see the matrix for what it truly is?
Good evening, traders. Good evening. Good evening. We're back again with another video on the divine algorithm. Today we'll be talking about the divine algorithm, how everything ties in together. We'll be looking at the pair USD CAD, giving a few examples, understanding institutional order flow, Elliott waves, Wyckoff, ICT concepts with the market maker buy, market maker sell model, harmonics, and a few SMC concepts. We'll also be looking at time, how time moves, what divisions times are in, and how to see the power of 3 cycle, the accumulation, manipulation, and distribution cycles. So without further ado, we're going to get this video started. First, let's start with a word of prayer. Dear Heavenly Father, we thank you for this day. Thank you for everything that you've done for us today. Thank you, Lord, for giving us this knowledge and bestowing it upon me so that I am able to teach people what you have shown me. Pray, God, that you'll use me again as a vessel to showcase what you've given me and allow it to be taught clearly and with great detail, and that it'll be understood very easily. We thank you again, Father, for your saving grace and for allowing us to be profitable and giving us this skill to be able to provide for our families. Pray, God, that you'll just be able to continue to bless. We love you and thank you for everything you've done and everything you're doing. It's in Jesus' name we pray. Amen. All right, so we are going to start out with this pair, USD CAD. We'll look at a few things that happened this week. We'll review the month of December, as well as up to this point in this month or this year, which we are halfway through this month. And we're just going to go over some things, right? Again, this concept is called, I call it the divine algorithm. It's because it's something that God showed me. I prayed for this and he showed me a lot of things that happen in the market fractally all the time, every time. Again, some of these concepts are old. All of them tie in together. It's nothing new. They're all most of them are in books or been taught on YouTube. It's just that each person has their piece of the puzzle, and they don't completely tie everything in or learn everything to understand the framework and the structure of it, right? So let's first start with some ideas, and once we start with these ideas, we'll move from there, right? So as we understand, there's Elliott waves, right? Elliott waves give a 5-wave cycle up to a 9-wave cycle. You have impulse, or you have a motive and a corrective wave, right? The motive, there are impulsive, motive waves and corrective motive waves, right? So that all works. It's just giving an idea of market movement. So Elliott wave is the idea of market movement. The key to Elliott waves is understanding what swing point in the market to use to project your next swing, right? Elliott waves are still delivered algorithmically because it's natural movement of the market, nothing else. Harmonics are just numbers, series of numbers of swing points connected in the market in a harmonious movement numerically, right? So that's all harmonics are. They are a complete market cycle, right? Inside of a harmonic pattern, you'll find the ICT concept of market maker buy, market maker sell models. You also have Wyckoff, which is what ICT's concepts are based off of. They're based off of Wyckoff, but they are not Wyckoff. Let's understand that. That's why he says his concepts are not Wyckoff, because of the precision aspect in his concepts. But his concepts have a basis off Wyckoff in the aspect of an accumulation, a point of manipulation, and a point of distribution, right? And what they have is a gathering of orders. Then you have a buying of orders or a markup in price. Then you have a distributive point where it comes to the high, and then a markdown in price, right? So there's a up and a down, which is the market maker sell model, market maker buy models. There's a buy side of the curve, sell side of the curve. There's a sell side of the curve and a buy side of the curve, right? That's your markup and markdown in prices, because that's literally what we're looking at is a markup in prices, which would bring a price into a premium price point. And we're looking at a markdown in prices, which will bring prices into a discount price point, right? So that's simply all we're looking at when we look at those things. And we're going to get ready here to go over some examples and understand fully how this market works and how it moves. So without further ado, let's start getting into some examples. So as I stated, we're on USD CAD. We're on the daily chart, as you can see right here, daily chart. And to a lot of people, this just looks like a lot of up and down movement, but there are very certain patterns within this, right here. All right. So what we want to do is let's first understand where we are. So right here, as we go back, what we're going to do is we see this market in this area here. It's inside of a range. So let's first find our parent swing of this entire range, right? So if we look here, we see that we have a high, let me take this magnet off. It does better without the magnet, right? At least on the circles. Okay, so we have a high, make this orange. So what I do is I color code what I do. because it's easier to keep track. That lets me know with the orange, anything that's orange is something that's on the daily chart. There's a high, that's our swing low, right? So you see the swing low and you see the swing high, right? And these are our highest and lowest price points within this range, so that we know that we're consolidating inside of this range, right? So in that, you can do two things. You can mark an equilibrium, right? We got a high and a low here. All right, there we go. And there's your equilibrium point, right? If you would like to mark that, you can mark that equilibrium point. And the number on that is 134561. 561. Mark it as an equilibrium, so you know exactly where that is in the market, right? So we know that that is our equilibrium point of our range. So we have a high, low equilibrium point, right? Now, as we see this, let us understand what is going on in this market. So we'll get our chart, we scrunch back, and we can see that we have an even higher and an even lower time frame. We have a void. We go here. This was our high point with a consolidation. The last up candle before the down movement that broke structure. We're looking at this candle here. Well, these last two up candles, right? And we have a gap, a for value gap. This was your liquidity pool that was taken out inside of this gap. So we can mark both of these. You can mark this low here. Let's see. Right there. Then you see how we tap into that over here, Bink, right? So you can go into your highest up close candle right there. There's your low. It's your daily order block, right? That it comes into, right? Daily order block. So that is marked. And we can also see here in our low point, we have a high and a low that takes out a previous swing low right here. Then we have a consolidation and a bullish breakup. This is our last down movement before our harsh movement up. This is the buy side imbalance that closed above these three candles. This here is your order block right there. So you can mark that as your daily area of bullish order block. Right now, with these PD arrays, we could have marked the for value gaps, but since the other one is further back, there's no need to mark that. Now, since we've started out with marking out our arrays or our premium and discount equilibrium, right? So we have a premium price, 139,415. That's our premium pricing. We know that above this equilibrium is all premium pricing. We know that below it is discount pricing. This is our lowest discount price that when we come into that area, we can reasonably expect buying to take place. Now, what we see is an impulsive range. Now, after an impulsive range, this is a motive wave. We know that this is bullish. This creates a bullish range. After a motive impulsive range, there is a corrective range. That is what we see here. A consolidated corrective range, right? In reality, this is what we call a running flat, right? This is a running flat. So it is a corrective range inside of the motive impulsive range, right? And it is a gathering or an accumulation of orders. Now, we understand the range as being a large range. We can see it is from the 129,500 to the 139,500, right? So you can understand the pricing is a good 1,000 pips, right? So you have 1,000 pip range to move within. So that will give you an idea of the reasonably the range that you're dealing with and how you can move within that range. Now, before we get started with the other concepts, let's understand that we're going to look at harmonics. Now, harmonics, the key to understanding each thing such as harmonics, Elliott waves, ICT concepts, the quarterly theory by day, time is where it's found and how to spot it. With harmonics, they are found best in a consolidation or a gathering of orders, right? Usually the best harmonics are within a consolidation or a range. So you'll see a range begin with a harmonic, and usually you'll see a range end with a harmonic to give the final direction. Now, using the Elliott wave, it will give you what type of range it is. And that's why I say we understand that it's a running flat. We can see that through the Elliott wave. It tells you, okay, there is a phase 1, a phase 2, and a phase 3, right? Same thing with Wyckoff. Wyckoff is a structure of the market where there's a phase A or a buying climax, an automatic rally. Then things happen. You get a spring. We get a sign of strength, right? You get the spring. Then you come back here with a sign of strength, test, right? Then you can get a MSAL, or that MSAL, I'm sorry, you can get a test 2, and then like that. Now, the Wyckoff schematics that you find on the internet, you have to basically take them and kind of understand what is happening in those schematics and be able to write your own schematics. You have to understand how to become a market engineer, right? That's basically what you're understanding is the market movement of price, the markup and the markdowns in price. Now, ICT gives you that concept in a whole different precise level in the market maker buy, market maker sell model. So let's start with the examples, right? So we see that we start here on this side of the market. We had that impulsive range that happened September the 12th, 2022. It came up to our highest point on October the 13th, 2022. Now, there are a few things that happen within this market that gives us ideas of selling and buying, right? And there are certain things that you can spot within this that'll give you an idea of what is going on in the market, right? So we get our impulsive wave. You see this wave of all black candles. Then we get a swing low right here. Once that swing low is formed, that is your short-term swing low. So you'll mark that. Now what we're looking for is price to buy up past it. It comes back up, takes the high. You see how it closes here? Notice right here where we get this bearish engulfing and push down past this swing low right here. This is the change of character. What changes the character and why is it called a change of character? This is simply, with explanation, this is where they start to hedge in sales to cover the longs. So they're hedging in shorts to cover the longs, right? Again, they're hedging in shorts to cover the longs that are in this market. So they began their sell program right here. This is true divergence. This is when divergence starts, right? Right here. This becomes your change of character, right? So you get that change of character. Change of character and a market structure shift are two different things. I want y'all to understand that they are not the same. ICT's market structure shift is not a change of character. If you sell in a change of character, most likely you're going to get taken back out, right? You're going to get taken out because after a change of character, there's usually a swift run to the upside or to the downside, right? And we'll go over a bullish aspect, but this is a bearish change of character where you can see the bearish engulfing. It breaks this swing low. That's the key. It breaks the previous swing low, only a single swing low, and then immediately moves back up to the upside. What does it do? What is this for? This is a creation of liquidity right here, right? This creates the liquidity right here on these equal highs to run it out, right? Every time price is going to go into a area of premium to reverse, it will always create liquidity and there will be a stop run. Right here, there's the stop run. These are the stops that are above here. It's looking to dip into this order block where this liquidity pool is, or where these orders are, these buy stops are. So its rating creates buy stops here, and it's already buy stops here. So it wants to raid the stops above here and raid the stops above here. So they create this area to make it seem like it's resistance with this bearish engulfing. This is where retail sells because they see the bearish engulfing. Knowing this, we understand that it's a change of character. We know that we are just setting up a liquidity pool of buy stops to then again offset all of these longs in these buy stops and in this bigger buy stop liquidity pool. I hope y'all caught that. Let me say that again. After the change of character, there is a swift buy up. It creates an area of buy stops or a buy stop liquidity pool right below a bigger buy stop liquidity pool. What the algorithm is doing is spooling prices or spooling stops here to offset the longs that were created in this motive wave. It offsets the longs that are created in this motive wave, right? Now, after that wave, we understand that this entire range is going to be bullish. After that, there is a correction in price. Price creates this smart money reversal, right? So you have this impulse, right? And you have a buy side of the curve, smart money reversal. This is your market structure shift right here. This is the true market structure shift right here. This is what you look for. This was the swing low that was created after the change of character. Market structure shift. After a market structure shift, that last up candle before that down move of that market structure shift will become your order block. This becomes your order block. Right there. Now, the key to this here, after a market structure shift, there is always an optimal trade entry. After the market structure shift, there is always an optimal trade entry. This is my pattern. I trade the optimal trade entry. Now, true enough, you can use this wick, this high, but the reason why I'm not using that high is because these are I like these bodies. It's better to use bodies, the highest up close bodies. Now, you could still get an entry here by using the wicks here, and it's still going to hit the 62% retracement level. And then again, look how it also gives you an idea of, let me go there, give you an idea of a 0.5 standard deviation of that range. But if we were to take and go here to the bodies, same idea, go here to these bodies here, it gives you a better entry, right? You can see how it hits this 72% retracement level, almost to the 79, doesn't quite reach it, but it gives you a better exit. Look at that, how it taps that one standard deviation of those bodies. From there to there, one standard deviation of those bodies, right? What is this low here? This low here is 132284. This is 32293. So 2928. You're right, a pip off, right? Pip and some change, right? But it's a great exit, right? Understanding that. So again, we're looking at you get this change in the state of delivery. You get an accumulation or reaccumulation. You get the reaccumulation here, the change of character. This is where they start hedging in shorts to cover the longs. They push out to take out the buy stop liquidity pool created above these highs into the bigger buy stop liquidity pool that was in this previous order block that we marked off, right? Notice how this range is here at this 127 level. Look how cool, how that is, right? That's what you look for. One standard deviation. Beautiful. Now, what we need to understand is that this was a impulsive range. This is your second stage of, this is your distributive range. You had the market structure shift, right? So we had a market structure shift right there, market structure shift. This is your area of distribution, first stage of distribution. Second stage distribution comes down into the destination, right in here, to take out what the bodies below here, that swing low. You see that swing low right there? Look how it just comes right to it, moves back up in this range, right? There is a for value gap from this high to that low price. This is the last time price was offered at a sale, from this high to that low. So we can mark that. I want you guys to see this so that you can see each piece of the puzzle. There's the for value gap. Price fills it right there into that balanced price range. From this high to that low is the balanced price range, right? You get that from that high of that candle to the low of that candle inside of this for value gap. That is your balanced price range. We accumulate change in the state of delivery right here Again, we go on the lower time frame. This will be your market structure shift. This is your order block right here. You can mark the body of it, right? Mark the body of that. This becomes your bullish order block here. If we go to a 7-hour time frame, I like to use the 7-hour, and we'll explain why later. The 7 hour is beautiful, and it gives you insights that you will not normally get. But check that out. There was your daily for value gap, right? There was that swing low that we looked at right there. Look how it just taps right below that swing low. See that swing low? Right into that for value gap. What did we talk about? You get a stop run, change in the state of delivery right here. You see that? Right there. There is your change, right? Right here. Change in the state of delivery right there. Once it breaks this short-term high right here, that's your market structure shift. Accumulates, pushes up, comes back. Remember, once you get that true market structure shift, there's always an optimal trade entry. From this body to that body, 62% retracement level, order block. And we move up to 1 standard deviation right there. You see that? Now, this is all the market maker buy, market maker sell models. Remember, over here we were at the buy side of the curve, the sell side of the curve, which is setting us up back for the buy side of the curve, right? Back into this buy side of the curve. This was our daily order block. We came there, had a change in the state of delivery right here. You see that? Change in the state of delivery right in there on that market structure shift. You see right here. Down, back up, then it delivers down, right? That was your second stage of distribution. See where it ran the stops, ran that. There's stops above here. There's your void. This up candle before this change in the state of delivery becomes your order block now, right? Look how we run right up into that order block. We can go back to the daily time frame to look at this also. There's your daily up candle before, look, that hard run to the downside. See that hard run to the downside? Creates that market structure shift right there. Gives you a second stage of distribution. Now over here in this understanding, this range here is a corrective range. So you had an impulse, then you had a B, C, and a D, or a corrective range, right? So you have an impulse and a corrective range. That is what you look for, because understanding that gives you the framework of what you're looking for. You have to understand the type of range that you're in, or the type of delivery that price is giving. Again, there are two types of delivery. There's a motive and a corrective delivery. The motive is going to be your impulsive, hard. It has to get where it has to go immediately, right? So understand, you can be in a higher time frame corrective wave or corrective delivery, and a lower time frame motive delivery. See right here, this was a lower time frame motive delivery. It had somewhere to go at a quick pace, motive delivery, right? This is a hard motive delivery on the daily time frame, where there's several daily candles that are delivered up with no down candles, right? There's a motive wave, a impulsive motive wave. Then you have impulsive corrective waves, right? This is an impulsive, but it's in a corrective wave. Impulse, corrective wave. Impulse, but it's in a corrective wave, right? That's where you get your distribution, right? Or the markdown. This is the covering of the longs, the shorts covering these longs again. Gives you the smart money reversal, creates the order block. They cover more, enter more shorts here, and then they give the impulsive range to take the stops of this sell side liquidity that they engineered here. That's the key. The market engineers and delivers on liquidity. It engineers and then delivers on the liquidity where it's going, right? Once you see this stuff and understand how it is combined together, then you're able to build structure and framework around what is happening. Then you can understand that I'm in a corrective wave and it could be motive. In a corrective wave, there are going to be low resistance liquidity runs, right? So in this first stage of distribution, low resistance liquidity run. Second stage distribution gathers these orders, covers the shorts, covers the longs that is entering here, shorts again into these longs to cover its longs here. And there is your area of short covers right there, right? So we see that. Then we get the change in the state of delivery. Again, your order block here. And then look, motive wave. We're still in a corrective wave. Now this is your market maker buy model, right? We've come down, sell side of the curve, accumulation, reaccumulation, reaccumulation. Then we get a up into a premium side of the market. We're above equilibrium, premium side of the market. There's your high, creates a area of what? Buy stops. You see where they come down, they engulf here. See this engulfment of this up candle, both of these up candles, they engulf that. There is your change in the state of delivery. This is your change of character. Now, understand why this is a change of character. Again, what do we speak about the change of character? They engineer a area of buy stops into a bigger buy stop liquidity pool, right? So here is your engineered buy stops, right? There's your buy side liquidity, engineered. They come and what do? They run that here in this high. Change of character. They run this. This is your this is where it changes the state of delivery. This in turn creates what? An order block at the change of the state of delivery. That is how you know when the order blocks will work. Again, that is how you know when the order blocks will work. The order block is a change in the state of delivery. This is by ICT himself, understanding that an order block is the change in the state of delivery. This is where they started their shorting program. They started hedging in shorts to cover these longs in this range, from this range to this range. Now there's a liquidity pool under here, liquidity pool. They created another liquidity pool, swing low, swing low. There's a liquidity pool under there, right? Understanding that our range is now from here to here. We've taken the internal here out of this void and this for value gap, right? Again, there's another for value gap. We'll mark it out just so you can see it right there for value gap. Look how we trade up into it, wicking, 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 wicking. Order block. We trade up into that order block. See that? Lower that order block, hitting it, right? Get rid of that daily for value gap. Engineer buy stops, change of character, where they engineered they're starting their shorts. This is where they push up, take the buy side liquidity pool back up into the order block where the higher buy side liquidity pool resides, right? So we know that this was our daily order block here, right here, out of this low daily order block. Engineered buy side liquidity changes the character, moves up, takes those engineered buy side, take the engineered buy side liquidity, creates the order block here with the change in the state of delivery and a bearish engulfing. Notice every time there's a change in the state of delivery, there's an engulfing candle. The engulfing candle simply means that this body is bigger than this body. Same thing here, order block, bearish engulfing, right? It's going to engulf that. It's going to engulf that body, but it's not the engulfing pattern that creates the movement. It just gives you an idea of understanding when it's going to happen, right? Or seeing certain aspects in it, right? But this was the change in the state of delivery. That engulfment changed the state of this buy side delivery, right? Again, the engulfment changed. It is just letting you know this is an engineered candle, letting you know that the algorithm has changed its state of delivery. This is your change of character. Change of character simply is meaning that they are hedging shorts or hedging longs in to cover a discount prices or premium prices. So here, they're hedging in shorts to cover in a premium side of the market to cover the longs. We did this again. Here is what under here. What is this? Tell me what it is. I want you to say it out loud. Market structure shift. Right, there's your market structure shift. Market structure shift. What do we say happens after a market structure shift? Right, every time you have a market structure shift, what happens? Market structure shift, optimal trade entry. There you go. We're going to move this all the way out. Right there, right? And we'll expand this over so that you guys can see this. Let's expand it over. Again, I can't make this stuff up. There's your high. There's your low after the market structure shift. There's your 79% retracement level. Optimal trade entry. What happens? Immediate delivery to the downside after it taps that order block. Look how it taps that previous daily order block right there. Up, taps the order block one more time in the optimal trade entry, right? Taps that order block at what? Right here. Immediate delivery. Then what does it come back up and do? It rebalances this range. This is an immediate rebalance. ICT talks about this is an immediate rebalance. Once you see this immediate rebalance that comes back up into this bearish order block, you know that there's a short program in circulation. So this candle opened, bought up, takes out this low back up into this daily range. Right here into what? This order block. Right? Pulls back up into that order block to rebalance this entire range here. Rebalance, redelivered, immediately moves to the downside and shifts into the where this liquidity pool here, and again this liquidity pool here. Now look here, from here to here, look how it delivers right there. Look at that low. This is 132.62 and 5 pipettes is what this low is. We got 1, 3, 2, 6, and 9 pipettes, like 4 pipettes off. But it delivered. It gave you the 1.5 standard deviation. It gave you the delivery. The right here is the range that gives you the projected delivery of where price is going to deliver to. You see the engineered liquidity here. Again, this was your order block, right? Look how the bodies respected 50% of this order block also, right? We need to look at that here. Right there. Look how the bodies, wicks are okay, but look how the bodies are respecting 50% of this order block, right? That's what we're looking for. 50% of this order block. You can use these bodies here as your entry, because under these bodies inside of this on a lower time frame is engineered liquidity. These are the things that you should go back and study when you see this right here, truly this order block is an accumulated range. You see how the high of this order block and the low of this order block, the candle bodies are inside of this high and the low, the bodies. Then this breaks out of the body, returns to the opening, and then pushes away. This is your accumulated range, right, of the buy side of the buy model, original consolidation, right? Again, there's the model again, right? Original consolidation, accumulation, reaccumulation. This is your smart money reversal, change of character. You get the smart money reversal, market structure shift, first stage distribution moves, second stage distribution to what? The liquidity pool that was engineered under this inside of 50% of this range and this order block right there, delivered right there, takes out the liquidity pool engineered here, here, and inside of this range, right? Let's go to our 7 hour right quick and just take a delve into it and see what is down there, right? Okay, right here. Daily order block. There was your 7 hour order block right there, but you could use 50% of this one, but this was your true order block right here. This down candle here, the opening of that candle is going to deliver to, right? Look how sensitive the opening of that candle is. Again, we have these bodies here, but they aren't delivered to. You got this candle here, where's your it's engineered, so you could probably take this candle, go down to a lower time frame, and see, let's see here, I don't have a, we'll make it that. Right, 7 hour order block bullish, we know that, right? You can go down to a 4 hour time frame or a 3 hour time frame, right? If you go down to the 4 hour, you'll get your, see that market structure shift right here, running stops, changes the character right there, right there. This is the market structure shift right here. This is your order block right here, that 4 hour order block at that high. You should be able to enter there. Let's mark that right here and look at the entry on that here. Look, see, entry, bodies respected right there. Even if you wanted to go down to the body, there you are. The best entry that I like, this is an entry technique. I don't talk about this, but we'll talk about that later, are these kissing candles right here. Kissing candles should give you an entry. See, bing, hits this to the T. Look how this low is 1 2 7 3 4 4 3. Look at that right there, right at that order block. This is your rejection block. This price is rejecting out of this zone, right? 4 hour order block. Look at how precise that is, right? Precise. Everything is precise in the ICT concepts. That's why I like it. It gives precision, right? Precision. That is what his concepts are about. His concepts are about precision, understanding precise delivery and what the algorithm is delivering to, right? So let's go back up to our daily, right? And we're just using our daily because I want you guys to see this, because the higher time frame narrative is what you're looking for, and this will keep you on the right side of the market. This is what we come practice every day, and this is what we look for. Again, here's our change of character right here, right? Let's look at this, because change of characters look several different ways. See, swing high right there. There's where the characters change. Now, why would we know that this is a change of character and that they're still going to deliver to the downside? Because look, they engineered liquidity here and liquidity here. and they haven't delivered back down into this. Right here, they delivered to the high, look, but look, it didn't even come into what? The body of this candle. We want it to come into the body of that candle. Changes that character. See that? There's your second stage of distribution. Stop run creates the change of character to the second stage of distribution. Then they hedge their shorts down into what? Where their longs, to cover these longs inside of this original consolidation. They need to cover these longs and these longs. Did they cover these longs? Not yet. Not here. They did it. But when they come back here, they covered the longs, right? You can look at that as your, because this is your second stage of distribution. You know that this is going to be a sell-off. You can look at this as your change of character also. Right there, that's a change of character. Right? Because what happened? Even here, from here to here, it delivered only to that downside. Did it take the liquidity in this range? No, it did not. When it bought up, it just came back up, right? It bought up into what? This area here in this down candle, these kissing candles in this down candle, and then sold back off to where the liquidity pool was here, the area that we were looking for, right there. Right now, where is your market structure shift? You had this right here after that change of character. Again, market structure shift right there. Right there is your market structure shift right there. Market structure shift. After the market structure shift, what do we look for? Optimal trade entry. There you go, your optimal trade entry right there. Right now here, the reason why I would elect to take the wicks here is because on this daily time frame we have a wick down and a wick up. If you look over here, when it's optimal, when it's created, look how you see how we got two of these long wicks here. There's a long wick here, long wick here. This is a rejection block. When you have a rejection block here, you're going to take the wicks. Okay, so there is this is one, let me say this, there are several different types of optimal trade entries. Not all optimal trade entries are the same. There are several types of optimal trade entries. Again, you have this type of optimal trade entry after the market structure shift, where you have these bodies. I would not take this wick. I'm not going to put it on this wick, even though it's right up there and this was the swing high. I'm not going to take that wick. I'm going to take these bodies. It's going to be more it's going to give you more complete confirmation of this, not this wick. This body is going to be better. You see how these bodies close? There isn't a large wick there. See, no large wicks. And even here, no large wicks. There's a wick here, but no wick here. Right? It just opens and price immediately moves down. That lets me know, take these bodies, use these bodies. Now, look here. We had a change of character. We had the market structure shift. When we had these, look how we have a wick down and a wick down. Here there was a wick down, and then it takes this here. This was a stop run right there. That low was a stop run, right? That low there is a stop run on a lower time frame. See, it takes that daily low. This is your change in the state of delivery. It's going to pull back into this candle down here, this rejection block area. But you can take the wick. So you take the high of this wick, which this wick's high is 134.756. You take the low of this wick here, right? See that wick there, 3265, 3265. Look at the low, is right there. This candle, 3265, 3265. And this is our optimal trade entry. This is why I have these numbers here. So look at that 935. It delivers right to it and immediately moves away. But what I want you guys to actually see, this is my wick entry, understanding when and where this type of optimal trade entry will form. But not only that, the idea here is this is where I understand that it's going to deliver down into this rejection block at this wick, hence the 935. 835 is another type of delivery also. Each one of these are types of deliveries that I understand is going to happen with a optimal trade entry. There's your low, high into the optimal trade entry that happens here at the 935. This is your wick, but the key is to notice how the body's respected this 79% retracement level and this 72% retracement level. The body's respected. You see that? See how the body's respected? Even though the wicks go down into it, the body's respected, right? Again, if we go look at this on our 7-hour time frame, you will be able to see some ideas here. All right, so again, look at here. What do we talk about? Change of character happen here. Look at that immediate, see that hard push there? That's letting you know this is what you want to see, because this is getting everybody involved into a sell. When you see that hard push down after this hard push down, that was a take of stops. That's your change of character. You know that, right? Engineered liquidity pool, engineered, look at these equal lows, relative equal lows. You know that that is a engineered liquidity pool, right? So it gives you that idea right there. There's your change of character. It pushes down, right? Now, let's remove this right quick. What do we talk about? It gave you another second stage distribution. This is a, remember, market maker buy, market maker sell model there. So a fractal pattern, right? This was a consolidation, right? This is a harmonic pattern also with a drop down there, right? All of this ties together. We'll go back over the harmonic patterns later so that you guys will be able to see. What I'm doing now is giving you a review of everything that happens fractally with the smart money concepts and ICT concepts, understanding algorithmic price delivery and how it delivers all the time to the same way. Right now, you see this here. This is your order block that it delivers in. Right here was when the change in the state of delivery happened. Right out of here, see that hard push down, stop run right there. This is the last down candle. This is your engulfing. Again, what do we say was going to be there? An engulfing candle. This is your opening right there. Look at that. You see how that opening, what does it line up with? The 8. Let's see here. Let's look right there. There we go. There's that low. Look at that 835. The 835 lines up with what right here? This for value gap. You see how it lines up with the high of this candle right here? The high of this candle is 132977. This is 974. You're 3 pipettes off the high of this candle. But what is this from this candle's low? Let's look at that. Zoom into that. From this candle's low to this candle's high. For value gap. What comes before a good order block? A for value gap. You can enter there as your entry, or you can understand that this is a rejection block. Again, had that 935 rejection block. Drop down into your 4-hour. Take a look at it. Then you see your stop run, bullish engulfing right there. There's your 4-hour rejection block. Again, your 7-hour was down there. Go to your 1-hour. See if this trading view gives us the 1-hour price delivery all the way back to there. Look at that accumulation right here. Your 1-hour rejection block. Look how the closing low is down there. The lowest close on this 1-hour candle is down there. Right down there, there's your lowest close candle. Look how it delivers to it right there. Right back to it. This is the close of this candle is 132.744. Right, and let's make that green so we know that it's 1 hour. Right, we'll do that with a 1-hour rejection block. Look at that 1-hour rejection block. What did it deliver to? The low of this candle here, 132.743, just into that rejection block. Remember, this is 744. Right into that rejection block. Precision, precision, precision. There's your order block. Rejection block right there delivers down into it to take out what? Engineered liquidity in these bodies. Remember, the bodies have all the volume, right? These are just runs to get their lows. They push price into that. The algorithm will. It's like stabbing into the price to get it lower. They're pushing into it, you know. Let's see here. How can I equate this? It's like pressing the puzzle pieces together. So it has to push this puzzle in, push that piece in, push that piece in. Then it comes back. This is where they engineer all the stops here, and then it delivers back to it. Look at that precision of that delivery there. The precision of that lowest close. The closes are very important. Closes and opens are very important because the close of the next day is the close of one day is the open of the next day. So remember, closes and opens are very important. So the close, it delivered to the close of that down candle, right? Remember, this is our 7-hour order block. Right here, these two down candles delivered to that, right? This was our stop run that we talked about, that daily low. Look how it ran that daily low once, twice. Market structure shift, right down there. There's your market structure shift on the right there and right here, right? So let's go back up to our daily. Look at this again. Keep looking at this, right? So we understand there's our 1-hour rejection block that we were able to pinpoint there. This was our, remember, this was our optimal trade entry. It lines up with our 935 rejection block. Your entry is here at the 935, gives you the entry. You pinpoint entry and you move up immediately, right? There's your pinpoint entry. Stop goes below the low, right? Easy money. Then you can move up each day. You can hold this and this move where you're looking to move above this market structure shift. First, this is your market structure shift, optimal trade entry, and then we can readily find our price delivery. Look at that, 1.5. Now, what I do like to do, and I want to state this also for understanding where price is going to deliver or project it, I like to go to the bodies. I will move my fibs into the bodies and we'll get a better projected state. Look how we get that 2 standard deviations right there. Now, the next idea is you're looking for the 2 standard deviations, buy side liquidity, buy side liquidity. Look here, buy side liquidity. old high, rejection block right here, right? There's your, this is a rejection block. So we can actually mark that. Let's mark that here. We'll do that. Daily, we'll just put daily OB negative for right now. But let's change it. Let's put rejection, rejection order block, right? So anyways, we come up into this area, right? We take both of the buy side liquidity pools, right? We take that buy side here. And this is another type of market structure shift. You get this here, market structure shift here, right? On a lower time frame, this is a swing low that is presented here. This is a swing low that is presented. Now, this is special. Why is this type of market structure shift where you get what we call a failure swing? Look at that. That's the failure swing market structure shift. Now, the other ones were all stop runs. You see how we had a stop run, move, stop run, move, stop run, move, right? We take the internal liquidity pools inside of this range. Now, what's important about this was our impulsive range that started this whole idea. This from here to here to here to here is a whole corrective range, which creates another impulsive range. There is your idea of the harmonic pattern. That is a Gartley. There is your harmonic pattern. High, impulsive, corrective range, failure swing, move away, right? Go to the lower time frame. This was your market structure shift right here, where it breaks this, it creates, engineers the liquidity. Shift the market structure. This is a different type of market structure shift. Shift this, but what are you looking for? Again, the high, the low, optimal trade entry. After the market structure shift, remember, there's always a optimal trade entry here to there. .79% retracement level right up in there, moves away, right? So not only could you have had a delivery up in here, understanding that the idea is we take from this high to this low, and we're looking for a 786 delivery, a 786 delivery from here to here. We have our harmonic fibs, right? Understanding that 786 is what we were looking for. There's an equal liquidity pool here. Between that and the 886, you can go to your lower time frame and find the best thing to find is try to find a for value gap where the liquidity pool is. Liquidity pool, low to high for value gap. There's your for value gap. Once that is created, you drag that across. 50% of that is your entry. Consequent encroachment, entry. See that? Now, what did we tell y'all earlier? That what is this? This is your change of character. Didn't we just talk about that earlier? There's your short-term low that was created right there. See that? Short-term low runs up into that, engineered by stops. right? Let's erase some of these fibs. We'll get some of these fibs out the way so y'all can see this again. Failure swing. This is your failure swing entry. When you get a failure swing like this on the daily time frame, here it's just the same thing. It was what was happening over here, but on the lower time frame. Again, change of character. Engineered buy side liquidity. Engineered buy side liquidity. Runs your highest up close candles right here becomes your, this is your order block here, right here. There's your order block right there. Now, significant about this is this is a breaker. High, swing low, last down candle before this up move. This is your breaker. So there's your breaker setup. Ah, shoot. I put weekly breaker, but it's not a weekly breaker. We'll just put this zone right here. That's showing that it's a bearish breaker right there, right? Market structure shift. Remember, we talked about this being your market structure shift, right? Understanding where and when that market change of character, right? This is your change of character right here. They changed it, right? When they broke the low, but they couldn't pull back up to short these out. They shorted this out after this right here. You see, they're buying up into it. That when it broke that was the change of character. They came back up. What did they do? Take out this internal liquidity pool from here to here, which is a for value gap on this time frame, right? This is your for value gap. Let's make it make it look like that. There's your for value gap. Now, is it a coincidence that this for value gap is inside of this breaker right here, and it taps that? Look how it taps that. Runs that liquidity back up into consequent encroachment, comes back up inside of the breaker, hits the back of the breaker and what? This for value gap, and then proceeds to move away. Then this is your 2022 model right here, right? After this state of delivery, after you get your optimal trade entry, you'll get a for value gap, institutional order flow entry drill right here, or the 2022 model, and then it'll move away. Another, no, this didn't happen there. You could use this also as your 2022 model right here, which is after the market structure shift back up into a for value gap and a continuation, right? So just understanding this on this level will give you this idea. And this is why you look at these charts. Failure swing on the higher time frame, but the same thing happens. It's just fractal, a different type of fractal, a different type of, it's just a different type of delivery again, right? It's the different type of delivery, but it's all the same. It's fractal. It's just you looking at this and seeing it form live in time. You go back and you see what it looks like. Once you keep looking at this over and over, you'll see it form in live in time without any problem. It'll be easy the way it'll form. You'll understand it, right? But there is your delivery, right? So what are we delivering to? Again, we had our optimal trade entry from the daily. completion of a pattern. Remember, this is a harmonic completion. Gives you this. You can take some off right here because this will give you about 100 pips from here. Right? It's going to give you 200 pips. So you can take 50% of it off, 80% of it off, whatever you like. Bank profits right there. And you're understanding that this is your market structure shift. Under that low is a market structure shift. Once you understand that, right, you could see that take you some profits. You're going to take some profits right here coming into this because this is a for value gap. So you're going to want to, at least at that high, take you some profits. Then you let it accumulate. Why? Because what you're looking for is you're waiting for it to come back up. Now it does come back up here, shifts that market structure. So you can understand that there are 3 different opportunities to get into this. You can get in here, gives you a good 170 pip range, 180 pip range, 180 pip range during that week. Then what does it do? It shifts back up into what? This order block right there. There's your daily order block, comes right up into it and then begins to deliver to the other side. There's your daily order block right there, delivers up right up to it and then shifts away. So you had entry here, and this optimal trade entry, right? It's your optimal trade entry right there. See that failure swing, 835. There's your failure swing optimal trade entry, 835 right there. Now you're looking for where it will deliver to. Look how the bodies deliver right to here, right? What do we talk about? Oh, shoot. What did we talk about? The bodies here having a liquidity, right? Where's it going to deliver into? The last down candle before the up move. There's your down candle, daily order block right there. You see that daily order block? We could deliver down into that daily order block, right? And then push away 50% of this candle's wick here. But the bodies are where the liquidity was resting below, right? Right there. Takes those stops, push back what? Up into this range. Well, what does it push up into? Right? We get our reversal, smart money reversal, back up into this area right here. This is your for value gap. See how it pushes up into that? Now you have a down candle. So let's look at this because there are 2 things that are happening here. There's a down candle before this up move and this push away on this market structure shift. This is your failure swing here. This candle here is what? What would that candle be? I want you to say it before I say it. All right, I gave you a chance to say it. I hope you said it out loud. That is a mitigation block. ICT concept of a mitigation block. This is your mitigation block right here. Right, price pushes back up into that mitigation block. You can also look here, this down candle here, for this up move of this failure swing. What is this candle? Say it before I say it if you know. That's right, it's the breaker. So you have a breaker, a mitigation block, right? And then back into, what was this? Right here when price came down. What is this? Optimal trade entry. Again, over again. 62% retracement level, right? Optimal trade entry. We're above equilibrium right here. We need to, I need to mark this equilibrium as, that way we know where the equilibrium is, right? So We're above equilibrium, bearish breaker, bearish mitigation block. You can use the close of that as the entry. Again, the close of this candle. Close of that candle, entry, right? So you can see the delivery. It comes back up, look, and then it touches the low right here, moves away. So you have this right in here where it shifts away, comes back, another failure swing, creates a failure swing again, right? Do you see the failure swing? Creates the same fractal failure swing. Impulse, correction. This is a harmonic pattern, which will be a bat pattern. Or I'm sorry, this is a Gartley. This is one of those 100% Gartleys, or that 935 Gartley optimal trade entry. You can use it as a Gartley, an optimal trade entry. This is the daily, but if you go down to your 7-hour, it's definitely a Gartley pattern right here. That was your failure swing Gartley pattern. This was your order block where the change in the state of delivery happened. Rejection block, right? No, it didn't give you a rejection right there. But you can see where it overlaps here, right? Overlaps. Then look, gives you change in character, or change of character, I'm sorry. This gives you the market structure shift, optimal trade entry again, and then moves away, right? Gives you this here, brings you back up into this right here, down candle before this exacerbated up move, breaker, moves away again, right? So there's your harmonic. There was a harmonic, also harmonic state of delivery, right? You get a harmonic state of delivery. This is how we're using the harmonics, right? You can see the harmonic delivery before we move away. So you could have got a delivery here, easy, stop above the high, stop above that high, right? Or you could have moved the stop above that high. If you feel this was too much for you, right there, it's a 100 pip stop for a 400 pip, 528 pip reward, right? It's a swing trade, but you don't even have to have your stop that high. You can understand where it's coming into. Stop could be above that, right? You could have a 20. It really doesn't even require that much of a stop. If you saw the harmonic, this would be like a 25 pip stop at most. And if it took you out on that premium side, again, this is the key. The key to harmonics is that you're in premium price range. There is an area of structure that is delivering to, right? And the harmonic is present with a impulse and a corrective range back up into. So this is your original consolidation right here, right? Whole original consolidation gave you a liquidity pool to deliver above, delivers down, right? Then it comes back up with a smart money reversal. Then it re-accumulates right here, gives you the smart money reversal with the distribution right here, second stage distribution, or this will be your first stage distribution, second stage distribution. Then it comes back down into delivering where? Into that daily order block that we talked about, right down in here, right down in here, right? So the same thing happens all over again. We go back to our 3-day. Let's go to our daily. And as we come back into our daily, look at how all of this happened. You see all of the delivery, right? Now we're back into the same fractal patterns. It delivered what? Down into this daily order block right in here, right? Now, what you could have looked at is here from this low to this high. This is a buy side imbalance or a sell side inefficiency, or BISI as ICT calls it. You can look at this high to that low is a for value gap, right? So you get that for value gap. What do? You drag it straight across. Price delivers into that for value gap. You can look here also and look at this. There is a swing low, a swing high. See how that swing high? It comes right above this swing high. See it right there? Just ever so slightly, and then pushes low and takes out that swing low and this swing low. This range here, or you can use this entire range here, but I will be looking at this candle specifically. This one, that would be your breaker, the range of your breaker right there, right? But you can see that this is where they started their buying in this area here, right? This is where the buying started, right in that candle right there. So right there, and we'll make that a buy zone. Right, so you can see that there's a daily order block, overlaps with a daily breaker, and a consequent encroachment of a for value gap. But look how we deliver: breaker, for value gap, order block. All of this, you don't need all of these to get your entry, but you can see all of it happening and occurring in this major swing low that's out of this consolidation. This is where your bullishness happened, out of this hold down candle. Right now, again, we had the same thing happen right here. Pulls down into here. What do we have here? Change of character. Right, there's your change of character right there. Right, see how we ran up, change of character. Look at this hard state of delivery. What did it deliver back down into? Our daily order block. See, we delivered into the order block, we delivered into the breaker, gave you a move up, right, and then came back and shorted. They still needed to cover what? The liquidity inside of this range. There is a here, could have given you even a precise entry of an IFVG right there, right down into this here. From there to there, you could use that as this delivered down, and this here, this is a you could use that as a balanced price range here. Order block all the way down, right there. But these are the things that is present right here. You might have gotten taken out and fooled by this change of character and right here, because even though this is here, this is not the market structure shift. The market structure shift really doesn't happen till here, right? You see that right there. Bink. There's your market structure shift right there. Short-term swing high. Short-term swing high. Here to here, optimal trade entry, back down into that daily order block, and then it's delivered to the upside, right? Delivered to that upside right there. So do you see that? We had the change of character, ran the stops, right? We had to run these stops. Stop run, bullish engulfing. This is your order block right here. This creates the new order block. But we come in, look how the bodies respect 50% of this order block. This is what we're looking for. all the bodies respecting 50%. They dig into it, digs, working that low, hits that daily order block that's just above that 50%, pushes away. Optimal trade entry on your 7-hour time frame here. Right. What do we talk about? Market structure shift right here. Out of there, internal liquidity. Swing low is here where it took the low. See right there. There's what you're looking for. Swing low. Swing high. There's your optimal trade entry again. We're taking the wicks on this because of the way it's formed. Those 2 wicks gives you an idea. When you got this here, there's not enough body, so you know that this is going to be wicks. You got 1 wick, 2 wicks, you know that's going to be a 935 optimal trade entry, and the daily order block is below the bodies, right? Rejection block right there. And this is your real order block right there. If you're looking right there, that's your real order block where the change in the state of delivery happened right there, right? Market structure shift right here. See right above it, market structure shift, optimal trade entry from here to there. We'll move this one so that you can see from here to there. Optimal trade entry, 72% retracement level, moves away, hits the same idea once more, then we move away. Right, and then it will give you an idea where to deliver to. Right, we've got a daily rejection block up here, bing, that we should deliver to. Right, and again, this is the same idea with the market maker buy, market maker sell model, right? Smart money reversal, original consolidation, shifts. This is your first stage of accumulation, right? Or you can look at this first stage of accumulation, reaccumulation, engineered to stops, smart money reversal, right? Optimal trade entry, first stage of distribution, second stage distribution, back down into what? Original consolidation, right? So do you see how we've gone over this whole entire price leg? Now, again, this was an impulsive range, corrective range, bullish butterfly from here to here to here to here. That's a bullish butterfly, right? Down into what? A for value gap breaker. That's what we're looking for. I'm looking for the harmonics to deliver down into certain price points, into the ICT concepts, right? Again, here is another idea of a delivery. Original consolidation. There is your shark pattern. Bullish shark pattern to come up out of this. We've already delivered 50% of it. We should come back and then the movement should be forward from there, right? There's your shark pattern. What does it deliver to? It delivers down into this range here. Delivers down into that range there, you see, right? And we get the movement up. There's your shark pattern. Now, as we had the shark pattern, remember we had the butterfly here, had a bullish butterfly, right? The bullish butterfly. Now, with all that being said, you also have what? Another where we have a price delivery of a impulsive range. Then we start a corrective range, an A, B, C, and a D from here. So see, A point, this will be your B point, it's the highest. C point for the lowest. D point at your highest, right? There's your corrective range right there. So do you see the triangular aspects in it? That's what you're looking for in the market geometry. You're looking for the triangle connections of it. Now, if we were to pull out our Fibonacci and how the numbers, this is a bearish shark, an extended bearish shark that goes to the 113. We're going from this high to that low right there. That is the original impulsive range from there to there. This comes to the middle, or so this becomes X, A, B, C, and D, right? And look how it doesn't quite deliver all the way up to that 113, but just above that 100 level. So you could even use where this original impulse, you can, if you even use this here, because this is where the impulse started, right? You can see it that it did deliver to the 113. So you could use this range because of the failure swing. This is actually where the impulse started and the consolidation was here. It did deliver to the 113 like it was supposed to. Came down to the 382, back up to here. This would be a 116 or a 141 if we were to look at the projection. You reverse it, look at the projection, 114. Look how it delivers to the 114 and wicks back up. That is within our specs, within our now we're looking here. Delivers up to the 113, gives you the idea and moves away. But remember, we're not entering at the 113. We're just expecting it to deliver up to this range. And then we're waiting, we're looking for the delivery up into what? The order block, the rejection block, right? And we refine our rejection blocks. But we understand that this fib level is around the rejection block, which gives us the idea of what is going on, right? So then we get the bearish shark. See that? Bearish shark. Now, as you can see, we're in a consolidation. All these patterns tied together in this consolidation, right? Everything ties all together. Gartley. Butterfly. Shark. Right? All these patterns tie together. Like, once you start seeing this, this is the divine algorithm. How everything, all of it, ties together. Look at it. You see it? It's all the same. We explain each and every piece through the precision concepts of ICT, giving you the idea of the market maker buy, market maker sell models that happen inside of this this idea right here, right? Now what we're going to do is I'm going to get rid of this, and then I'm going to show you guys something else, the market maker buy, market maker sell model, specifically inside of this, right? So we'll control and we'll erase all of this. All right, so you guys saw that. Now what we're going to do is we'll go ahead and delete that too. Right now I have a previous layout of this particular price range on the daily. Right, so this was our original, what we started out with. We laid out the entire range from beginning to end. This is where we are now, right? Original consolidation. Remember, we talked about smart money reversal. Original consolidation, right? Reaccumulation, smart money reversal, market structure shift, first stage of distribution, second stage distribution, completion of the pattern. Right here, back down into what? The daily order block right there, right? So let's look at, let's look here. And what we'll look at is this divine algo here, right? All right. So as we see this, look at how it is laid out. Market maker sell model. You see this? Buy side, first stage, reaccumulation, daily order block. Do you see how that original consolidation starts here? Your daily order block is that down candle that is moved here with this bearish engulfing or bullish engulfing. This is your first accumulation, reaccumulation, first stage reaccumulation, second stage reaccumulation. Looks what's right here. A balanced price range, engineered liquidity, creates the smart money reversal for the buy up, reverses here. This is your smart money reversal in this candle here for the lower time frame. The up close candle for the down move of the market structure shift creates what? Your daily order block. I did not mark your optimal trade entry, but here you see that again, optimal trade entry is formed. Give you an idea of where price is going to deliver to. 2 standard deviations right there. Right, you could have held this from November. This is a month. This is a swing trade. Nice little swing trade. 620 pips. Right, on a swing trade. And you could have had several entries. There were several entries in here. Right, just using your model. Right, optimal trade entry for me. Here's another optimal trade entry for me. Another optimal trade entry. All I had to do is wait, drop, 62% retracement level, drops again. Optimal trade entry, lower resistance, liquidity run. That's what you're understanding is in the fractal of the harmonic pattern. You're understanding the buy side of it and the sell side of it, giving you the idea that we're in the low resistance liquidity run. We're coming back down into the original consolidation. That's what you're measuring in a harmonic pattern, a move from the consolidation, the impulse, and then the corrective range, right? We understand that this here is the impulsive range. This first range from here to here, that is your impulsive range, right? This is the impulsive range. This is the first corrective range, right? So it starts this idea of an A to B to C to D, right? There is your corrective range. We're understanding that corrective range right there. Understanding that all of this is a corrective range, right? This is where you get your retail patterns of a ending diagonal. Let's clear some of this away first, right? You got your accumulation here. And look how this whole month of December here, when you start here, look how we started December 1st. Second stage redistribution, delivered, easy delivery. All of December, you could have took 400 pips the whole time, just letting it ride every day, coming looking for a sale, coming looking for a sale, coming looking for a sale. That's the idea. When you understand you're in the low side, low resistance liquidity run, look at here, high, low, breaker, balanced price range. This was your breaker right here. See that down candle before this up move, close of that candle. Look how price delivers up into that close, and then we move away, right? You even got this area here for this up delivery, this down candle here for that up delivery inside of this candle. The key is it's inside of this candle. You can't use this candle. Why? Because it's not inside of this candle. Look, you see, it's the body is, but you're not. This candle is inside of here, and you got kissing candles here. So you can use this, the low of this close of this candle also. Look how we get a delivery up into that, right? Now, right here, you have a delivery down, back up, then down again. That there is this idea. Balanced price range. Balanced price range. So when you come into that, this up candle here or this candle here will be an order block right there. At the kissing candles, there'll be an order block. Well, let's mark that, and we can go down to our lower time frame, and we'll see that. Let's go down to our 7 hour. See that up candle, 2 up candles. What did I tell you? It will be an order block. You see, order block. There's your shifted market structure right there. Optimal trade entry. We got wicks. Wicks. What do you measure from? The wicks. Look at this. Optimal trade entry right at your 935 order block. 935 delivers to that 2 standard deviations. Look at that. Perfect delivery. I'm telling you guys, I cannot make this up. It is all happening fractally every day, all the time. This is how harmonics move. This is the idea of Wyckoff with the mark up. This is your calls where it reaches its destination, gives you a mark down in price. This is the ICT market maker sell model. Buy side of the curve, split it in half, sell side of the curve. Right? This is this idea. All the same. It's a harmonic pattern. It's a market maker sell model, market maker buy model. Balanced price ranges are in here. Market structure shifts. Understanding this. This is what I've been working on and looking at into, right? Once you understand this concept here of how to spot this and understand these things, especially when you're on an idea like the daily time frame and you see something like this, you know will deliver. This is the idea that you get that you'll for certain will deliver, right? And look how we've come into what? This up candle here. Out of this down move, we've delivered back here. We have to have a short term. Whereas here, this is a sell side liquidity pool down into what? This right here. What is this right here for value gap? What is that? Order block. So we should know that most likely we'll have a this should be a change of character here where it delivered through. See how it delivered through this whole entire gap right here? See how it delivered through that? That is a market structure shift on a lower time frame. See that? Swing low right there. See you had right here, push down, gave you your optimal trade entry into what? This rejection block here. This is your failure swing. failure swing, liquidity pool for value gap, order block right in here. Right, you see that order block right here? I would take that right here. See, another for value gap right here. I will be looking to buy this right here. You've already had the market structure shift right here. There could be a possibility to grab this and push back up, but this is going to be a low resistance liquidity run. Right, we've delivered up into what? For value gap. This is your order block on the daily. Shift for value gap right there, moves away. Right, so you can see where price is delivering. Delivers right now. We know where we're at, so we're able to capitalize on this idea. Right now, we've went over this idea of how this moves and what it's doing. Now I'm going to give you guys the idea of time. Now this has been a long video, but if you stick with me and understanding this divine algorithm, I'm just giving you an intro to everything. And once all this stuff is understood, then we'll build on these concepts. But I'm just building a whole video to understand each concept, right? And we have understood each concept. Again, let's look at how this is an Elliott wave, right? Also, we see that you have a 5-wave delivery on the Elliott wave. Let's understand that, because see, this is incorporated to, you have a 0, first, second, third, fourth, 5-wave delivery. See that? You run up your second wave, third wave, fourth wave, right? There's your Elliott wave right there. Then you get your A, B, C, D, or the corrective side of this range, right? Now inside of that corrective side, there are 2 more corrective sides. There's an A, B, C, D, gives you that. Then it gives you an A. Let's see here. You can't really see it here. Let's see. Hold on. I'm sorry, I gave it to you at the wrong place. But it starts. I'm sorry. The D here is right here. This D is delivered right there. Right there. Slight impulse. Then it's A, B, C, D. There's the delivery. Right, that's how it moves. There's your 2 states of A, B, C, D inside of that. Right, and your failure swing. So that is how the Elliott wave is in here. All right, and you can get here. This is a 38.2, right? This, you can measure your Elliott wave from here to here. We use the harmonic fibs. See how that's a 38.2, 38.2, 50%. Look, it comes down to that 50%. Pushes up to that 1272. That's what we're looking for, 1272. Now, what we are measuring is from this swing to this swing should be a 50%, 618. And again, it should be to the 1272 or to the 1618. Look how it comes back in, 50%. Delivers to the 1272. 1618 is here, or the 141 is here in between this range. But what's there? Our daily order block, a daily rejection block. Look how 50% of these 2 ranges give you a price delivery. Right, look at that, 50% of those 2 areas. Wick price delivery moves away. Right, but there's your Elliott wave. Now from here to here, again, you were looking for a 1618 delivery from here to here, but we know that that's our optimal trade entry and that we could see where it'll go. We know that it's going down to this daily order block, right? Without a shadow of a doubt, we know where it's going to go, back to our original consolidation, right? So there's your idea of this market maker sell, market maker buy model, right? There is the idea of it and the movement of it, right? Now, as we have that idea, let's go here. We'll take all of this off, right? We'll capitalize on that. Now, this is what I want you guys to see. So the concept that we're going to start out with is price moves in time. So the time element, we're going to start out with the daily idea, the daily and monthly idea of how price moves. You're going to be looking at 3, 6, and 9 as Tesla stated. Now, that will be 30, 60, and 90 days. Now, the idea is also that we're going to look at the number 4 too. The reason being that we're looking at the number 4 is because we're looking at the power of 3. So there is an accumulative range, a manipulative range, and a distributive range. In Day's concept, he has a AM, D, and an X, right? So the AM, D, and the X can be a continuation or reversal, but usually it's a continuation. But the idea is that price time is divided into not quarters, but threes. The year is 12 months. You can do 90 days or 3 months per quarter, which will give you 4 quarters, right? Now, the idea that I want to give you on this divine algorithm is that it's divided into threes because of the accumulation, manipulation, and distribution. You want to take the 12 months and divide it by 3, which gives you 4 months. That's why we look at the 4 months or the 120-day cycle. It gives you a truer time frame cycle rather than the 30, 60, and 90, or even the 20, 40, and 60 that ICT talks about. They're very close, but the 120-day cycle is truer because the idea is that each month is a 28-day cycle. Every month there is either 2 days of time distortion or there's 3 days of time distortion. If the month has 30 days, it'll have 2 days of time distortion. If it has 31 days, there are 3 days of time distortion. Time distortion is always an aspect. There will always be time distortion in every time delivery. There has to be an aspect of distortion in time to complete the cycle. Right? So when we talk about intraday, for right now, we're going to talk about the daily and the yearly delivery of price, right? We're not going to get into the intraday. I'll do another video and dig deep into the intraday cycles and the hourly cycle and how it moves, what the hourly count is, what the hourly cycle is, and how it moves every day, right? And we'll talk about that 24-hour cycle. But for now, let's look at this 120-day cycle. Here it is here. Now, this is what I want you guys to see. We start at the beginning of the year, January, we go back 120 days. Here's your 120 days at September the 4th, right? And we can do 2 cycles. Let's do 2 cycles, which will be to the middle of last year or the beginning of last year, because April is the beginning of the year, right? And conveniently, April was what? The end of this cycle, or there was a end of this cycle going into May right here, right? April, the month of April, was the opening and the beginning, or the beginning of this cycle here, this 120-day cycle. So here's the AMDX concept, right? So we start here, 120 days. You spread your quarters out. At the first quarter, here's your accumulative range. What happens? So let's start over here. Here at the beginning of the year. The beginning of the year is January, but the true year opening is in April. So again, remember we had this breaker. We had a range that ended the year. This swing high, swing low. There was our failure swing. Remember we had this impulse to start the year, and then we had this correction back up. We had a low and a high created, right? There's your accumulative range. It accumulated the beginning range here, but we're already inside of accumulated range, or the ending range. This is the ending range, the ending cycle range, right? You created a low and a high to end this cycle. So you want to mark that high and you want to mark that low. There are buy stops below there. What are we looking to deliver to? Remember, we had this daily order block down here that we spoke about earlier, right here. So we know where price is going to deliver to, right? So we understand that. This was our market structure shift, right? We get our market structure shift, optimal trade entry, and our delivery. Now what we're looking at here is this is our accumulated range, because from this high to this low, we're still, until we break this low, we're still in that accumulated range. Look how when we get right here, what do? We immediately drop down, break that accumulated range. This is our manipulation. What is it manipulating to? It is manipulating down into that order block and taking those sell stops that are down there. It's covering its shorts, right? Look how we get that manipulation. What happens in this manipulative range right here? Do you see that change of character? Bing, change of character. And then at the beginning of the distributive range, as it's ending the manipulative range, we get that what? Again, accumulation, manipulation right here, right? Manipulation right in here. See how it starts? To manipulation right into what? Here, down into this area, and distributes into this range. Right there, do you see where it comes? Then you get the beginning of the X cycle, or what we call the continuation, right in here. And then moves up to what? Where these stops are. You see that? Takes out these stops here, right above that high, where this was created in that opening range here. Stops created. What does it do? Pull back, get your reaccumulation, right? Remember this? This was your first stage of the reaccumulation, right? This is your distributive range. We continue. Now, what I want you to notice is in this continuative range, what did we do? Price delivered right here out of this order block. But what specifically did it do right here? You see how it created that for value gap? Now, when we open, what do? We pull right back down into that for value gap and immediately moved away. That is how you know X is going to be a continuation cycle. There will be signs for value gap, institutional order flow entry drill on the daily, and then you proceed to move away, right? This area from here to here, all of this is a balanced price range. Let's showcase this from this body. This whole entire body is a balanced price range. Why? Because this candle, it opened, traded up, then this candle here open, traded down, or I'm sorry, it opened here, traded up and closed. This one open all the way down here. It gapped down, open, traded up and closed here. Then this one open, pulled back down into this candle of this range and then moved higher. That is balancing this range. See how this dips back in there? Also, there's your dip back in and then the move away, right? Dip back into that balanced price range, moves away. Right, there's your balanced price range. So you can see how these things form and understand when and where they're going to form. And you can see here, swing low, order block, right? You see the order block. You see it right here down. You know that this is going to be an order block. It's a bullish candle. It's not a down candle, but it's a bullish candle, but it's a inverted hammer. We know that it's going to be an order block. That wick is important. Why? Because price stopped there as it traded up and then opened. It stopped, closed here, open, traded down and traded back up. We know that this area is important in that wick. That wick is very important. So you can look in that wick and find some things, right? And this candle here is an accumulation on the lower time frame. That is an accumulative range on the lower time frame, right? Let's look at it so you guys can see. See that there? Accumulates, creates that gap, pulls back down into that daily for value gap. Even here, this is your 7-hour for value gap right there. Balance it, comes back down into it, pushes away. We know that this is your order block. Remember, we talked about this being the order block right there. That down candle right there, order block, price pulls back into it. What? Into this old for value gap right here that this wick came into. Look how it comes into that for value gap, hits it, and immediately pulls away for the continuation, right? So this is your time cycle. The 120 days is your time cycle, right? It gives you the accumulative range, the manipulative range where it pulls back down into its destination, and then it proceeds to distribute. It distributes, changes the state of delivery here, pulls back down into that state of delivery, and then moves away. What is this here? A daily order block right here at the high. Daily order block. Look, what does it do? Tap that. You see how these are all down candles in that distributive range. Daily order block, or this is a weekly order block, right? You can go to your weekly time frame. Right there, you see it right there. Weekly order block hits it, that down candle. All these consecutive down candles, you see it right there. Weekly order block in the manipulative range right there, right? So you go to your daily, you see where it happened right there. There's your idea for it to come back up into that and move away. Now you've completed that 120-day cycle, right? Up to here, September. So the cycle starts again. What does it do? It ends here. You see how we created a swing low right here, swing low. Swing high. That's your closing range right there, right? Or I'm sorry, right here. This is your lowest candle. Let's go with that one. Right there. There it is. We'll just mark that one. That's your closing candle. Got a high and a swing low right there. Immediately, this is your opening range. What do we do? This was a engineered liquidity. What does it do? Push up into that range, takes out what? This liquidity into what? What do we talk about this being? Mitigation block, right? Comes into what? Mitigation block. Mitigates these areas of buy stops and enters their short program back down into what? This daily order block. It gathers the orders. Second stage, it has to reaccumulate. Remember, we're in a second stage of reaccumulation without us looking at this. So we're just looking at the chart. We're looking at the second stage of, we're looking at, I'm sorry, the first stage of reaccumulation, right? So look, if we were to turn this on, look at that. It's first stage of reaccumulation. Second stage, reaccumulation. Do you see this chart is a little crowded, but do you see the idea that's happening here? Time and price, right? Excuse me. The time and price aspect. So you get the high and the low. There's your accumulative range. Now, once we buy out of that accumulative range, right, we haven't delivered to our objective yet, have we? No, we have not. So we have to get in there. Now, this is our manipulative range. What does the manipulative range do? The manipulation range is where you deliver into the destination. Notice what happened in this manipulative range. We deliver into the destination. We delivered once. Then it manipulated again to deliver twice into what? The destination that we needed to go into. Same thing here, right? We delivered into this this destination. Now you see that we had the stop run here and this failure swing right here. But this was a market structure shift with a failure swing and an optimal trade entry at the top of what? Our harmonic pattern. This was at the high of the harmonic pattern and also a completion of another harmonic pattern, right? Gives you the failure swing. That's what you're looking for. The failure swing gives you the idea. Where is it at? Perfect in time. Does the harmonic pattern complete? This is the time that the harmonic pattern completes. It gives you time and price delivery into what? An order block, right? And we're in the distributive range, the third quarter of our 120-day cycle. Distributes. Now we have a weekly order block, and we also have what? This breaker. Remember we talked about this? Down candle inside of here. Got two breakers. So let's talk about this, because these are concepts that ICT doesn't talk about, but that you should find these concepts out on your own. If you looked at the core content, he talks about order blocks. In there, he talks about a propulsion block, a propulsion candle, breaker, propulsion candle, wick. Does not see 50% of this. Do you see how it does not see 50% of this candle? Just the close. Does not see 50% of this candle either. This is your propulsion candle, propulsion breaker. Put that one out for everybody to see. It hasn't even been named yet, but it's an ICT concept. He's not going to tell you about it because he hasn't gotten there yet. But this is the propulsion breaker. That is your propulsion breaker. Second stage of redistribution. And then price moves away. What cycle are we in? The X cycle, the continuation on the second stage of redistribution. Now do you see how everything ties together? This is the divine algorithm. I've given you time. I've given you price. I've given you the idea of the state of delivery. Each concept is proven and it works day in, day out, and it won't stop. The idea is just understanding the framework and the delivery behind each concept. Once it is understood, this is how you see the charts. So I don't want to make this video any longer. We've already went about 2 hours. So we're going to end this here with these concepts. We'll be touching again on the intraday price delivery of the AMDX cycle, or really the AMD cycle, and then the distortion of it. We'll go into that later and keep moving through that, and we'll have this precision. It's always precision, understanding what's happening when, and this is how you can find breakers, because the breaker is in a manipulative range, right? Everything happened in a certain range. The order block in a manipulative range splits the cycle, right? Distribution to distribution. You can trade all of these cycles, understanding how it happens. 120 days, right? We've already started a new 120-day cycle. We're back on this. So we should see an accumulative range come back and deliver. And so we should see another accumulative range here, right? Once we see that, then we'll have our manipulative range, and then we'll distribute up into the higher range, the buy or the bullish buy. So there'll be a idea of the give you an impulse. It'll come back correct, manipulate, and deliver down into what? Look at these equal lows here. It's going to deliver down into an area. What most likely will it deliver into? Probably this for value gap down here into this order block to rebalance this section completely, right? So you'll get this, then it'll come down, and let's see if this matches with our 113. So you'll look here with our harmonic fibs. Look how that comes right in close to our 113, or you can pull it into where the idea started. Look at that 113 right in there. So that should be your sharp pattern down delivery to your 113 out of this. So you have the impulsive range first, come back down, and then you'll have the idea of a sharp pattern that delivers down into an area of 113, and there'll be a time element to this, and we're looking to enter in this for value gap, right? Or this IFVG right here. There it is right there. We're looking to enter right in that area, right? Oh shoot. Let's go and do this. This is a daily FVG, right? And we can expect to deliver price down into that area, right? It's right above our FVG. We don't enter here. We wait for it to deliver, to take the sell side liquidity here, right? That will be an idea, be a great idea for that. I will look for that, right? So you had an 8-8 delivery first, and then this could be our final stage of distribution. Then you'll get a change of character, same idea, right? And that's what we'll be looking at. So we'll just see how price delivers into our algorithm going forward with our 120-day look into our next AMDX cycle, right? So that is what we're looking for. We'll see how price delivers into that. So you guys see these concepts, the divine algorithm, how it works, what it moves like, and how all these concepts are tied together to create the idea of this algorithm. So thank you guys for tuning in. I hope this video was insightful. Until the next time we speak, may the Lord bless you and give you profitable trading.